Hello, and welcome to the RentFacts May webinar, Spring Your Investments Forward with Smart Property Investing. The question today is, are your investments fruitful plants or pesky weeds in your portfolio garden? My name is Erica Rosiska. I'm the president of RentFacts, and I'll be your host today, along with Scott Abbey, co-founder and longtime property manager. So first, some quick housekeeping from our webinar admin, Stephen Walsh.
Hello and welcome to the webinar. Thank you all for your time today. Just one real quick note. I'm going to show you how to ask a question during the webinar, which we will all take at the end of the presentation. So on your sidebar for the webinar tool, you'll see a section that says questions. So you can simply type in your question in that chat box, and then we will definitely answer your question at the end of the webinar. Yep, it's that simple. That's all you got to do is just go to the questions tab, type in a question, press enter, and we will address it at the very end. Thank you.
Okay. So sticking with our spring garden theme, and we should be on slide 3 here.
It's not showing.
We are here today to take the difficulty out of quickly determining which real estate investments are beautiful plants or pesky weeds. It really has to start with two things, which is understanding your investment goals and developing a reliable and predictable model of evaluation. So our goal is for you to walk away from this webinar with a clear understanding of how to put this analysis into motion. And we should be on slide 5. So first, next one. All right, so first let's start off by giving you an easy tool to quickly assess whether an investment is worth further consideration. Let's look at the ratio of rent to purchase price. There are a lot of equations out there, but at the end of the day, you can quickly assess each investment's viability from a ratio perspective. So has everyone heard of the 1% guideline? And forgive me for the repetition, but quickly, you know, if you charge $1,000 in rent and you're all in at $100,000, you're at a 1% ratio, right? So everybody following me? 1,000 divided by 100,000. So today we're going to be using a 0 to 2% or 0 to 2 scale, which is makes 1 the benchmark of viability. So next slide. Using this 0 to 2 scale, we can start to get a feel for what high ratios are versus low ratios. But what does that really mean for us? The ratios only show the potential, and therefore only the first step in evaluating viability. So in the example on the left, larger ratios provide higher margins of cash flow. Just like an aggressive stock, it can have higher return potential, but it doesn't come without risk. So the next step of determining viability is to look at and quantify risk. Here's an example of some of the factors that can affect your cash flow, both positively and negatively. We refer to these as location risk factors because many of these can be anticipated ahead of time just by examining the neighborhood of the property address. So for example, evictions are a cash flow killer, and everybody knows that, I'm sure, while longer tenancy durations make a positive impact on your cash flow. We must quantify these location risk factors as if we want to build a sustainable, predictable, reliable model of evaluating deals. So with that, I'll turn it over to Scott Abbey, property manager and co-founder of RentFacts. And he's willing to candidly share with you the model that he built to evaluate deals for his property management business. So take it away, Scott.
Thank you, and thank you everyone for coming today. As we all know, one of the big challenges when you're vetting property is you have to be able to do this with speed. There's a small amount of inventory available for us to choose from, so when we find an opportunity, we have to quickly act to see if it's viable to further pursue. And so what I do for my clients is have an understanding of what their expectations are as it relates to their willingness to accept risk and their goals for return. And we establish a range that they're willing to accept as it relates to a ratio of rent to all-in costs. And this is an all-in cost, so if there's a target that costs $45,000 and we need $25,000, we would add those two values together then to establish the ratio. So what we can quickly do is we can find a property, we can assess what the rents are, we can assess what the risk of the neighborhood is, and then do the math of all-in cost by the projected rents, and then it'll give us a ratio of whether or not this is within the tolerances or within the comfort range of the client that we're serving. And your numbers may differ from this. This is just our rendering of it. I've talked to investors from all around the country, and many investors in areas where the 1% rule hasn't worked for decades, and they're looking at percentages that are much lower. And what we've found in helping our clients is that as you lower the risk in the neighborhood attributes of the investment, you pick up longevity of tenancy, you pick up a reduced probability of eviction, an increased probability of appreciation. And so it's a matter of weighing the neighborhood risk with the expectation of yield that you as an investor or those that you're helping as investors care to arrive at. This is a guideline as I go to it, but it's a fast go-to. And if we find a subject target that is way off of what our expectations are in terms of ratio, we simply move to the next opportunity. We find one that is spot on, then our next task is to get inside the property and see what kind of costs are going to be required for us to understand the all-in costs. I hope this is helpful. This is one approach. I think you'll find that it's portable in other parts of the country. It just depends on the level of risk that you or your client wishes to take. Okay, Erica.
Okay. So let's examine further one of the more critical pieces of the model that Scott just presented. It's the piece that really still needs quantification, which is risk. And folks, this metric is similar to how a bank would determine viability of a consumer who needs a loan, and then what interest rates are going to charge. So what is the first thing banks do when assessing whether or not they want a loan to a consumer? They pull a credit score. And that credit score lets them know how risky it is to lend to that person. So lower credit scores are considered riskier investments, and banks will charge higher interest to offset the risk of the default. Higher credit scores are considered less risky investments, and banks will charge lower interest rates to compete for steady, reliable business. So, when looking at this analogy, you are the bank, and the property that you're trying to assess is the deal, or the consumer in this analogy. So your goal really is to evaluate risk, and the first way to do that is to pull its risk score. And RentFacts has created a risk score that functions similarly to a credit score. So just as a credit score is based on a number of different variables that indicate risk, like late payments or too much open credit, address hops, etc., the RentFacts score is based on various demographic variables that indicate risk to your investment income, such as crime to property, vacancy rates, tenancy duration, rent affordability, and so on. So think about RentFacts' risk score as somewhat like a credit score. You can just get the score, or you can dig into the details of that score by looking at the full report behind it. So here are some examples of what affects a risk score. You can view all the relationships online if you're curious about what types of factors affect the risk score, or download the handout available in the handout section of the webinar. So we now understand how to, 1, quickly assess viability of a deal, 2, build a model of further evaluation, and 3, easily quantify risk factors. we'd like to open it up for questions from our audience. So for either Scott or I, fire away, and Stephen, you can read the questions, and we'll go from there.
Fantastic. So if you have a question, please go to the Questions tab, and you can type in your question in the chat window there. Send it over, and we will gladly answer it. So again, go to the Questions tab and type in the chat window. I've got a question here from Shar from Raleigh. She's asking, my latest deal has a 1.7 ratio and a risk score of 20. I can see from my rent facts report that crime and schools are bringing my score down. What types of things should I be doing or looking to mitigate my risk?
Well, I'll take that one. Whenever your risk begins to get into the sub 30 numbers, typically you want to have a high sensitivity to vacancy and the exposure during the vacancy period. The other big issue that when you're dealing in lower risk numbers that attribute higher risk to the investment, you want to be extremely sensitive to rent affordability. One of the things that we see frequently is that although the market rents may be higher because of Section 8 and other things that help contribute to the rents, if you rent to a market tenant at market rents, you may very well find that you're putting pressure on the ratio between the income and rent. And from experience, I can tell you, you want to be careful to keep those ratios as high as you can. So we recommend lower rents in higher risk areas and using those lower rents to calculate your ratio so that you have plenty of margin in the transaction to accommodate lower rents and higher probability of interruption of income.
Looks like somebody had their hand raised, but then they lowered their hand. If you want to click the hand icon instead of typing in the chat window, we can unmute your line, and you can just ask
I think I accidentally unraised the hand. I'm sorry. Whoever just did that, will you do it again?
Let's see here. I think the name was Paula. So Paula, if you can raise your hand again, or just type the question in the chat window, whatever's easier for you. Got another question from Brian. He said, I've been seeing promoted deals with ratios of 3 to 6%, which is much higher than your scale of 0 to 2%. Can you tell me why that is and how those might fit into your model?
Sure. 3 to 6% deals would represent areas that more than likely have extremely high risk, or the math is flawed in that the all-in cost is not inclusive of construction. For this ratio to have viability, you want to understand what the purchase price is and what the necessary costs are to sustain the investment over a long period of time. So I refer to that as the acquisition cost, which if you're at the end of life of a roof, you want to put the roof on. If you're at the end of life on your mechanicals, you replace the mechanicals, and then the other necessary make-ready things that you do. And it's pretty rare that you would then find ratios of that size. So just buyer beware. Whenever you see deals that look too good to be true, they probably are too good to be true, and so you want to examine them. I don't think there's any property that you shouldn't consider buying. You just have to make sure that you provide yourself with enough margin in the transaction to sustain higher risk of the attributes of the neighborhood that you're going to be living with for the entire time you own that investment.
All right, Paula, I'm going to unmute your line so you can ask the question over the phone. One moment. Okay, Paula, go ahead.
I apologize. I came in 5 minutes late. Can you hear me well?
Yep.
Yes, we can.
With regard to your risk ratio, quantitatively, For crime and security issues that you mentioned, as it fits into your ratio, when you have an increased risk for a property, does that number within your ratio go up or down? How is that fitting within the ratio to do that specific measurement for that property?
It's a great question. First of all, we have two numbers that I want to focus on. The risk index number. That is a roll-up of hundreds of data points that quantifies the sustainability of income stream by demographic neighborhood. The risk score number, which is a RentFacts product, is what we use as the baseline for determining the risk portfolio. As those numbers go down in quantity, that means the risk is going up in severity. And generally, you want greater margins between the rent and acquisition cost because you're going to have greater uncertainties that are going to impact you negatively. So you want to create margin. You want to buy with margin, sustain the vacancies, the evictions, and the things that you're going to incur by being in neighborhoods that are of greater risk. Does that make sense, Paula?
Yes, it does. With regard to your risk factors,
Yes.
do you list as one of your points? I'm sorry. I can type it.
Sure. Well, as you're typing, I'll respond with some information. The risk index is made up of hundreds of different data points. But what the co-founder and I, Shane, as we were developing this tool, the goal was to help us identify the different issues. As I managed property over the years, I found that I could have the same exact footprint, the same house, managed by the same manager with the same credit, doing everything the same, but it impacted the outcome. And so we studied that for over a decade and developed roll-up data that actually there's 15 sub-indices and then one indice, which is the risk index number. And it factors in issues that have an impact on income stream. And it's proven to be an uncannily accurate tool for looking at properties. And if it's for comparative purposes, if you have two properties that appear to be the same, wouldn't it be nice to understand where they stand relative to the other neighborhoods within that given market? Because a lot of times if you go to Google Maps and you look at a picture of a house, you think, well, gosh, that looks like a fine neighborhood. But when you get under the covers and start looking at some of the demographic issues that plaguing that neighborhood, it might not be such a great neighborhood after all. And if you can find two deals, one with higher risk, one with lower risk, where you see a yield that's practical, I would encourage I think most investors would agree, let's take the property with the demographics that present less risk based on these attributes.
I just want to add, this is Erica. Paula, there is a downloadable handout on the webinar where you can download the top 40 attributes that the risk score is compiled from. So it'll let you know how those attributes factor into the risk score. Do we have any more questions or? Okay. Well, we hope you gleaned. Yeah, we hope you got some valuable information today and are walking away with an understanding of how to build a model that helps you quickly assess whether your deal has the potential to be a good one or a bad investment. So thank you for attending our webinar today. You'll be receiving 3 free credits for attending as promised. So be sure to check your email for the promo code shortly. We've also thrown in a surprise discount as a way of saying thank you for your time today and for committing to becoming a smarter investor. So if you haven't already registered for your free RentFacts account, be sure to do that first. No credit cards required or purchase commitment, and you do get 5 free credits just for registering. So If you like today's webinar and want to hear more, please join us for part 2 of the series in June, where we'll go into a deep dive of next steps into further evaluation after you've determined how a property address fits into your risk model. So look for that invite in your email soon, and thanks again, everyone, and happy investing.
Thank you.